One way for corporations to obtain large amounts of money for financing operations is through bonds. And this is going to be an introduction to how bonds are priced on the stock market. It's going to be different than stocks. So why do corporations sell bonds instead of selling stock? Well, think about the statement of cash flows. What are we looking at? The three areas are operating, investing, and financing. This is going to fall into the financing area. How do I obtain financing, large amounts for my operations? So the basics of financing, corporations can finance operations through equity or debt. With equity, we're talking about preferred stock and common stock. And then equity also contains retained earnings. Treasury stock, as you recall from the study of corporations, is when they buy back stock that's outstanding. So that is a reduction in total equity. So there's an ownership interest. But sometimes corporations don't want to relinquish ownership rights. They want to maintain full ownerships, but they still need to come up with a large amounts of money to finance operations, so they may decide instead it would be more beneficial based on their individual circumstances to approach debt financing instead of equity financing. And with this, we're talking about notes and bonds. And usually it's going to be the long-term notes. So we're talking about long-term liabilities. So what is the return to the investor? We have to think about that when we're trying to obtain financing from external sources. If someone buys our stock, they hope to obtain dividends. But of course, it's only if they're declared. With a note or a bond, there's going to be the principal amount that needs to be paid plus interest. When you issue stock, the investor buys ownership in the corporation. But when you issue bonds, the investor is loaning the money to the corporation. It's not a purchase of ownership. And many novice investors don't actually realize this. With stock, the corporation would have to obtain a corporate charter from a state government in order to issue stock. With bonds, it's also a legal application. It's a legal document called the bond indenture, and this identifies the terms and the rights and the obligations of the corporation to the investor. So the investor has a choice. They can invest in stock or bonds, but we're going to look at the other side of the corporation issuing the bonds. With stock, the investor hopes to have a return of dividends for their investment, and for a bond investment, there will be recurring interest payments and the principal at maturity. And there's the difference. Dividends only if it's declared, but with debt, the corporation has to pay interest. What is the bond indenture? Well, it's a legal contract between the issuer and the bondholder. It will contain the name, the par value. The contract interest rate is also called the stated rate, the maturity date of the bond, and the contract interest rate is the amount of interest paid over the life of the bond. That's the only thing you need that contract rate for, and it will not change. The market rate of interest, though, that's what the bond sells for. And there's often quite an amount of time between the initial application with government agencies to get the bond indenture and the time it actually goes to market and the indenture is granted and you are allowed to issue it. The sale price will be based on the market interest rate. So if the contract rate in the bond indenture equals the market rate at the time of sale of the bond, it's thought of sold as par. There will not be a discount or a premium. But if the contract rate is higher than market, it's sold at a premium, and if it's lower, it's sold at a discount. Now, when you think about why, well, the broad explanation is you just think about economics and what is driving a price up or down. So you have to think about what am I paying for my bond? What is my corporation? That's the contract rate, as opposed to the current market rate, what other bonds out there are paying. So you have to really think about demand for your product in the stock market. The contract rate is the interest rate you pay The market rate, that's stock market demand, what the market is willing to pay for the price of your bond. But in reality with bonds, it's whatever the calculation is based on that market rate, it's the present value of future cash flows. Now, what are those future cash flows? Well, there'll be a one-time maturity payment of the principal many years in the future, plus over the life of the bond, the corporation will have to pay interest, periodic interest. And most bonds are paid semi-annually, so twice a year they're paying interest, and that is known as an annuity. So they have a one-time payment of the principal plus the annuity payments, the recurring interest payments, and that's what sets the price of the bond. So now let's look at an example and try to help you understand why, if it's going to be a discount, if contract is lower than market. So let's say your contract rate is 8, and the contract, remember, that's the stated rate, that's what's in the indenture, that's the actual cash that you will pay. But if the market rate is 10, that means there are other bonds out there paying a contract rate of 10. Per the indenture, yours pays 8, but there are other bonds out there paying 10 if that's the current market rate. So yours will have a lower yield. The others on the stock market will have a higher yield, which is why you will see it recorded or sold at a discount. The price to attract buyers, it's going to be sold at a discount. And for the market rate, the stock market demand drives the lower rates down and the higher rates up. Now, keep in mind, that's a simplified example or an explanation. In reality, it all has to do with what the rate is and what the present value of those future cash flows is. The cash flows being the interest and the principal in the future. Now, if contract is higher, let's say your corporation is paying 8, but if market is 6, that means other bonds out there are paying 6. So the other bonds will have a lower yield. Yours will have a higher yield. The higher yield demands a higher price, and it's sold at a premium. Stock market demand drives the lower rate down and the higher rate up. So that's one way to think about this, to try to remember this. And the initial issuance of the bond, let's say it's January 1, 2011, you get $1 million cash, bonds payable, recorded. This is sold at par. There is no premium, there is no discount, because market rate was 8%. Contract or stated rate was also 8%, so it's sold at par. So think about principal and interest. So let's say your principal is $1 million, that's your bond. It's going to be paid in 10 years. And interest, it's 8%. 1 million times 8% to be paid semi-annually, that's $40,000 each month. So remember, semi-annually, interest is always stated annually. That's why it's 40 and not 80. Those recurring interest payments, that's your annuity. That's what an annuity is, recurring equal payments. So what does your bond sell for? Well, what's it worth today? Remember, it's the present value of all the future cash flows. Future principal cash flow, future interest cash flow. So how do we calculate the selling price of the bond? You have to figure out what these cash flows are worth today, and that will be with reading of the time value of money tables. So looking at an example, a $1 million 10-year bond at 8% stated or contract rate compounded semi-annually, and the market rate is 8. So N is 20, I is 4, because it's a 10-year semi-annually, that's 20 compounding periods. 8% annual, semi-annually, that's 4% in the first 6 months, 4% in the second 6 months. So how do we calculate the selling price? Well, 1 million times the table value, present value of 1. You read the table, find N and I to get 0.45639. So what is that 1 million worth 10 years from now? It's worth much less, 456,390. Then you have to figure out what's the present value of the annuity from the annuity. And you go to the annuity table. That $40,000 interest that you're going to be paying every 6 months, look at the table, find N of 20, I of 4, you'll see it's 13.59033, or that $40,000 annuity recurring payment. So if you took 40,000 times 20 periods, it would be much higher than 543,613. That amount is what that entire annuity is worth today. The key to remember is you take one interest payment, that 40,000, multiply it by the table value to get what the annuity is worth today. Okay, now this is $3 over. That's the present value. Why is it not exact? It's just the rounding effects of the tables. So it depends on the textbook you're looking at. Some of them carry out to 3 decimal points, some to 4. This one gives you 5. But in reality, it will go out much farther. And if you use present value calculations in Excel, it will be exact. Key to remember, contract determines N, how many compounding periods. The market rate will determine I when you're scanning the present value tables. So this was a January 1, 2011. You initially issued the bond. 6 months later, the first annuity payment, interest expense $40,000, cash $40,000. It's not $80,000 because it's paid semi-annually. Next year, 2012, June 30th, 2012, December 31st, you're going to have those annuity payments. And you would have had one at December 31st, 2011 also. But this just shows you how the scheduled annuity payments will be identical. That's what an annuity is. And at maturity, the principal payment, 10 years later, remove bonds payable and record the cash. And that's how you price a bond.